Okay, I can start the recording. All right. Well, this is the problem, man. People respond to it as if like they can show up, but like we've been slacking on the education. I've realized I'm getting like lots of responses and interest, and then not everyone shows up. But that's okay. Um, like I said, Yusuf and Niku get private lessons. I'm I'm gonna stop posting the recordings. Then people will definitely show up. Because now it's like people are so used to me just posting their recordings on YouTube. They're like, I don't have to come. That's like 90% of the value is being here. Like the last lesson, it was only Yusuf. Actually, no, Jimmy came as well. It was Yusuf and Jimmy at liquidity imbalance. And this guy was in New York and he still came. Okay, you guys can, let me share my screen. Yeah, you had a good reason. No, and also like Yojik and Niku were like completely different time zones, so that makes sense. I'm okay with that. Um, yeah, no, yeah, you're usually at all of them. That's true. Okay, so today we're gonna talk about. Let me just drag this out. I'm gonna give one last reminder, and then I'm just gonna starting. Oh shit, not at now. At here now. There we go. Okay, let's start. So today's lesson is going to be on standard deviation theory, and there's essentially three things I want to talk about. I want to talk about like STDVs that we all know, which are going to be three types. First is going to be manipulation legs. Second is going to be breakers. And the third is going to be distribution legs. Then secondly, I want to talk about projecting the Asian range. This is known as our central bank dealing range. And then thirdly, we can talk about targeting and price action within standard deviation range zones, we'll call them. So 3 concepts for today. So first of all, let's talk about what standard deviation theory is, why we use it, and why we can project price from any of these things. So the basic premise behind standard deviation theory is as follows. The market is not being booked, right, by these candlesticks that we see. And you guys have probably heard me say that before. The market is actually booked like this. Let me hide this. Right, with 2 axes. There is a price continuum axis on the x-axis, and there is a time continuum axis on the x-axis, and there is a price continuum axis on the y-axis. And the intersection of time and price is what we call a kill zone, where we have price action trading in a specific region in a specific time. Now, the reason why we can use standard deviation projections is because if we recognize that the price delivery algorithm isn't actually booking any of the candlesticks we see here, but instead it's booking specific prices at specific times, then manipulation, distribution, and or other types of candlestick representations of this algorithmic delivery should have some sort of internal algorithmic consistency, meaning they should be symmetrical to some extent. And that's why you'll often see when we're drawing out, market maker models, it may look something like this. Say this is our smart money reversal. We will have, and you can backtest this, symmetry in the distribution of the buy and sell sides of a curve. And this symmetry will be related to not only this axis of price, which obviously is going to be symmetrical because we're moving from an external range to maybe some internal range or external range down here, and then we're returning back, right, to that same external range. So obviously there's going to be symmetry with respect to this axis, which is the y-axis. This axis. Now, what we often forget about is that this is only one component of trading, which is just price, i.e. the value of the index. There's also this entirely different axis here, which is the x-axis, which is time. And as smart money concepts traders, we can take advantage of the fact that the algorithm is booking both simultaneously at all points in time with price. That's why we have kill zones, right? Or else we just always be looking for, distribution and price, but we don't. We look for areas which accumulate, we look for times which accumulate, and then we look for certain opens, whether it's true opens, 4-hour candle opens, 1-hour candle opens, daily open like MOP, right? The true week open. This is fractal with all time. Even true micro session opens are what we consider when we're looking at this axis. So what standard deviation projections allow us to do is to take a look at the manipulation that we see in price, whether it's from a breaker, a manipulation leg, or a distribution leg, and project that forward to give a forward-looking, right, look on price in time, right? So we can say that this is where price will reach for over time, and then we can also use something, which the fourth thing I'll talk about, which is gonna be time-based projections. Time-based projections. Now this is less taught and less traded with, and I'm still kind of fooling around with it, but I truly believe that there's an internal consistency to using time in all of the types of projections we see. And that's why you'll see the way I teach standard deviation theory is quite different than what you'll see on Twitter, and I look for specific manipulation legs. So as you guys know, you've probably seen some traders who kind of do this on every single manipulation leg, right? Standard deviation there, standard deviation there, right? Like, have you guys seen that? Like, people just choose random standard deviations. I don't do that for the most part. You'll see when I choose standard deviations, they will be based on this symmetry of time and price. All, right? Everything I'm teaching is in the context of a market maker model, because that is how the market books. So we're going to be looking at which standard deviations to use, why we choose those, manipulation versus breaker versus distribution leg, and then we're going to talk about where we expect to see them in price. So that's going to be this axis right here, the y-axis. Once we get a confluence of time, price, and structure in the context of a market maker model, that's when standard deviations have the most power. Or else, like, how do you know? Are you going to draw your standard deviation from this manipulation leg right here? It's a 4-hour chart. This manipulation leg. What about, this one? What about this one? It's hard to know, and often you're going to find confusing signals. Like, oh, look, this hit the 2, right? It must be that. But what about this one down here? Or what about this one down here? We're going to try and look at which standard deviations make the most sense to use and why we use them. What's the narrative associated with that? I'm going to teach you which one of these 3 I prefer to use, and then we'll briefly talk about CBDR and time-based projections. Okay, so that's the thesis behind standard deviation projections. It's essentially trying to capture the X and Y axis of algorithmic order flow. So let's take a look at how we use the first one, which is going to be manipulation legs. My favorite way to use standard deviations, by the way, is going to be manipulation legs. And that is because when you're looking at a weekly profile on a higher time frame, the manipulation leg is present in every single weekly profile. So a weekly profile without a meaningful protraction or manipulation, whatever you want to call it, is considered void, right? So again, this is now tying in, well, I cannot type today. This is now tying in our entire weekly profile lesson. So if I pull up some of the resources we have for that, where is it? PDFs and primers. This. The one thing you'll notice about the weekly profiling through the 3 lessons I taught is that if you do not have this engagement of a higher time frame PD array, right, you don't have a profile. This remains inconclusive as to what profile we have, whether it's going to be a classic expansion, a midweek reversal, Thursday reversal, right, which is called a consolidation reversal, or it's going to be a seek and destroy bullish or bearish delivery. What we need to see is this engagement of a higher time frame PD array. That by definition requires, right, some level of manipulation or protraction. This is how we use weekly profiling to say, where are we going to and where are we delivering from? So that is why manipulation legs are so powerful, is because they occur on a higher time frame every single week. That is the first thing I look for. That is my North Star, you could say, of framing standard deviations. So let's take a look at what that looks like on the ES chart right here. As you can see, there is a plethora of possible standard deviations you could choose, and on different time frames as well. What I want you to do is look for the manipulation leg that accomplishes, I'll make this a note. For manipulation legs, Let's talk about higher time frame and lower time frame. You know what? For the purpose of making this simple, I am just going to talk about manipulation legs today, just so I don't have too much information that's confusing. Now, these two guys, breakers and distribution legs, can also be used in the same context, but let's talk about the most practical standard deviation, which is going to be manipulation legs. Just know that these can be used when manipulation leg projections do not map to liquidity. So, if the manipulation is very large, i.e. a CPI candle, for example, something like, where's last Thursday? This was CPI. So if the manipulation leg is something like this, right? This isn't going to be valuable for us because we know we have daily PD arrays that map to projection levels that are much higher than this last manipulation leg, for example, before CPI. We want to use something that overlaps our liquidity, obviously. That's where I'll use breakers or distribution legs, and this is directly taught by ICT. This is core content. Or you can look into Dexter Lab. So this is going to be Trader Dexter on Twitter. He'll talk about some of the nuances of where you want to use distribution legs versus manipulation legs. I don't really need to go into that because the majority of the time, 95% of the time, I'm going to be using manipulation legs. Let's look at the higher time frame and lower time frame. On the higher time frame, I'm going to be looking for the manipulation leg that is responsible in context for the weekly market maker model, i.e. the weekly profile protraction manipulation leg. Here on Wednesday, we can see we have a very, very classic manipulation that leads to something called a midweek reversal. A midweek reversal is defined as the higher time frame objective. Let me pull up the Discord again just so we can keep referring to this chart. The higher time frame being objective, being protracted into on a Wednesday, causing a change in the state of delivery and subsequently spooling towards the drawn liquidity, which is going to be the other side of the range. Now, the better part about this manipulation right here is that we also have this SMT. So an SMT is the basis of an SMR. A SMR without an SMT is a fundamentally higher risk reversal profile. If you do not see a meaningful SMT between NASDAQ and the ES, really, so let's say NAS and ES, a meaningful SMT on any time frame you're evaluating a smart money reversal from, think of it, right, as a fundamentally higher risk reversal profile than when you see this algorithmic signature, which is tipping its hat to a reversal in the market. Now, this is something that I actually only recently picked up because I watched some core content from ICT, and he hid this somewhere. I don't know which month this is, but I remember hearing this, and ever since I heard that, I've considered SMT as a much stronger confluence, and I look for it actively. And if you guys were around last week in the live stream, like Yusuf was there, remember how I was saying I expect this SMT to form in this daily gap? I expected NASDAQ to not trade in to this daily gap because I wanted to see that SMT to bring us to all-time highs. And I remember saying that very, very specifically because an SMT is the basis of an SMR. So I'll write that. I think I wrote that down on this daily recap because I wanted you guys to remember this. When you're looking at your higher time frame SMTs, remember, that signals a very high confluence smart money reversal. So that is where you want to pinpoint your standard deviation and be like, that is the one that makes the most sense. What really irks me is seeing charts with 1,000 standard deviations. That's not how deviation projection theory should be used. That's not how it was actually even taught by ICT. That's how it's used because it's like a retail concept now where you just take deviations on deviations on deviations. You want to look for narrative. This move has a context associated with it. It's engaging our higher time frame PD array, it's forming our SMT, and then it's leading to our change of state of delivery. That is the only deviation projection on the higher time frame you want for the entire week, right? That's the one you want. That is where you want to see price deliver to in terms of those projected ranges. Fantastic. So that's what we're going to talk about in the higher time frame. Your roadmap for the higher time frame projections or deviations is going to be this. Wait for weekly manipulation. Now, this is going to go back to your weekly profiling lessons. So if that's confusing, refer to those. Wait for 4-hour STDV or 1-hour market structure shift. You'll usually find they're very similar. Frame that specific manipulation leg. And bonus points if you see an SMT. That is what you want to do on the higher time frame. Now, if you'll notice, this specific projection is a good one because where does it map to? Where can you immediately see the projection levels map to? 1, 1.5, and 2. Yeah, liquidity, right? On this 4-hour chart and also on this daily chart, right? 1 is a swing high on the 4-hour chart. 2 is going to be our weekly swing high, right here. And then look at where 4 lines up, right? 4 is very close to our other weekly swing high. Or you can say in this case, right, let's drag it all the way up to 4 and see how close it aligns. Right? Very close to that level, right? That's also inside this higher time frame rejection block. Do you see the bodies of these two candles? That's a rejection block, right? Because we're in a daily fair value gap. That's a very good liquidity mapping for the terminus. Terminus is going to be of this projected move right here on the daily chart, and on the 4-hour you'll see it a bit more clearly. I'm sure there's some 4-hour liquidity up here inside this rejection block. Yeah, right? All of this liquidity up here. So that's what you want to see. You want to see your deviation levels mapping to liquidity on the higher time frame, and those want to be your weekly, daily, monthly, higher time frame targets. Now, are you going to use this deviation projection here for a move lower? Why don't we come down to here? What's your narrative in your higher time frame, bullish or bearish? Yeah, so when we're seeing this protraction, you can use these deviation projections to understand whether we're going lower or higher, but you have to understand what levels are likely mapped to. That's what we're going to talk about in just a few minutes. So stay tuned for that. That's what we're going to talk about targeting and price action within the deviation zones. The first thing you have to understand is the context of the move being mapped with that manipulation. The context is more important than anything. You don't need the deviation. You already see the liquidity. You already know it's there. The deviation is giving you some forward-looking insight into, projecting that move. It's projecting that swing move in time and price. Look at this. You see how this is also symmetrical roughly in time? So if we take how many days to get here, let's take a look at how many days we might take to get all the way to 4. Right? Absolutely. This move here, we ripped against this low resistance liquidity, right? Now we can assume that we will probably reconsolidate somewhere here, right? So a 2-stage distribution. See how this is a 2-stage distribution here? First stage, consolidation. Second stage, consolidation. It's almost 3 stages, right? We can expect to see one aggressive move, consolidation, and then we want to look for another manipulation leg that can frame equivalent targets somewhere up here. Again, you'll see that's very common. Like here, do you see this? Down. Once we get the weekly profile, right? And we understand which of these we're looking for. I want to pull it up. Which of these we're looking at, right? Using the 4-hour STDV is essentially like using the guaranteed protraction, because the 4-hour STDV is what starts the new market maker model. Essentially, if you use this PDA, if you use this schematic, this is what you're looking for, right? This is the type of deviation projections you want to use. The ones that engage your higher time frame PDA, the ones that map to your higher time frame targets at the weekly profile level, not at the random manipulation. Like, for example, you see how, let's go to the daily chart. Do you see how this weekly move lower? I think this is, let's see. When do we tap this order block? Okay. So do you see this move right into this order block right here? This long wick up, right? That's obviously a manipulation. So this in here would be a good deviation projection, right? For the move down, that's going to rebalance our higher time frame array before being continuing bullish. Obviously, we're in bullish market structure, right? We're expecting bullish PDA. See this? Fair value gap, displacement. Fair value gap, what do we expect to see if we're in bullish order flow? From this fair value gap. Displacement, right? Right? Look, it's literally ERL to IRL to ERL to IRL, right? IRL, tap, take out ERL, right? In here, boom. ERL back into IRL, IRL, look at this swing high that's put in, taking it out, ERL, ERL back into what? What's this? IRL, IRL to what? ERL, right? Structure is not changing, and the better time frame to look at this is the weekly. Incredibly obvious. Internal to external, right? So you are not expecting this projection lower on this 4 hour, or I think it's better seen on the 1 hour even. Where is it? Yeah. You're not expecting this move to deliver 2.5 deviations, right? Everyone was bearish on higher time frames. There was no basis for that, but look at where the first deviation maps to. Oh, that must be random. Do you see that? Look, let me get rid of this one. Let me get rid of this. Wait, that's actually not even on the tick. Let me, you know what, actually, to illustrate the point better, watch this. There you go. Yeah, that's completely non-algorithmic, right? So let's look at this level. And for me, I'm not expecting a price move lower than that. Yeah. Do you guys remember me saying this in the server? I think I posted a picture somewhere. I must have. Do you guys remember me posting this picture somewhere last week? And I said completely random? I'm going to find this picture for you guys and put it again under this lesson recap. I called this out last week because this is worth journaling. Just this is worth journaling. This first standard deviation is algorithmically in time and price coded. Nothing else. It's coded. That's where price will deliver to. So now that we see that, we're waiting for a logical reversal level from here, which you can then see starts our midweek reversal. There's our 4 hour SysD. You can use, like I said, the 1 hour market structure shift level, or you can use the 4 hour manipulation. Like I prefer the 4 hour just because the 4 hour presents, the higher time frame hourly high. Remember that market structure lesson about intermediate term highs? This is not the manipulation move, believe it or not. Now it might seem like it, right? This is a lower high put in from this high, right? This high sweeps out liquidity, doesn't it? And it rebalances this inefficiency and taps this order block, right? What high, right? I don't know. It rebalances this inefficiency in here. Which high has more narrative associated with it? This high, that's New York, open of New York, or this high, which is 11 a.m. continuation. This is essentially the second phase of distribution in this market maker cell model on a lower time frame. Of course, right? This is the high that meaningfully interacts with all of London liquidity, rebalances in inefficiency, and then distributes lower. This is just a continuation sell-off, right? That's the high that you should frame it, because this is starting your manipulation. Do you notice how this is a protraction profile in here? Again, we're adding on concepts. So the reason why I choose certain levels isn't random. Do you see this protraction? This is late London protraction into New York reversal, right? This high doesn't have that narrative associated with it, does it? This high does. Look at this fair value gap in here. We're rebalancing, right? So that's the Yes. Narrative. You want to use a narrative-based high, right? That's why the 4 hour chart's cleaner. The 4 hour, you can see it. On the 1 hour, yep, yeah, right here. Yeah, it's a green candle. Yep. So on the 1 hour, this is a intermediate term high, right? But this is the real genesis or the origin of the move, if that makes sense. This is just a continuation of the move. And you have to see that by looking at the hourly lower time frame, being like, oh yeah, here's my protraction. I learned about that, right? Here's my late London protraction. Here's my first stage distribution. Here's my reaccumulation. Here's the intermediate term high. What is that called? Silver bullet, right? Intermediate term high. Second phase distribution, right? But this is the high that started the move. So then once we break above that, what's that called? Yeah, or SysD. SysD on the 4-hour, right? Once we break above this, and look at how price reacts to that SysD level, because this is a breaker, right? This up close candle is a breaker, and that's a fair value gap. What's that called? Unicorn setup, right? Do you see the narrative associated with this specific PD array? That is why this PD array is going to be the low, like the low of the rest of the week, right there. Boom, this right there, meaningful manipulation. So on a lower time frame, right? Say you're intraday trading. Great, let's feed this in. So now that we understand our higher time frame, we know what we're doing. We have a protocol. Wait for a weekly manipulation. Wait for an H4 SysD, 1 hour market shift. Frame that specific manipulation leg. Bonus points if you see an SMT. Fantastic. Now let's do the lower time frame. Don't fucking draw every manipulation leg as a standard deviation. This is useless. I'm gonna write this out because I've seen this so many times. It's not valuable to you. It's noise. These signals aren't valuable. Focus entirely on narrative associated moves. What is narrative? Pick a high quality PD array. Frame a lower time frame dynamic move, i.e. a market maker model. Use time over price. If price is the only thing you are framing deviation legs on, you're fucked. It's not about price. Do you notice how we choose this leg because of time and not price? What are we saying this leg does? What's this leg responsible for? I had it down here before. What's it called? It's the midweek reversal, right? Right? That is the responsible leg for, and is a midweek reversal time or price related? Well, you tell me. Is a midweek reversal time or price related? Time, right? Now, it's time and price because we're hitting a certain PD array, which is a price-based PD array. However, is a daily fair value gap time or price? Both, right? Both. So and people always miss time. And people just love to say, time is like whatever, it's important, but it's not like price. No. Focus on narrative. We frame the higher time frame manipulation because of time. This is the midweek reversal move. We're not framing this projection. Let's say this one right here. We're not using that. I don't care if it maps to the same targets. It might. That doesn't have the narrative associated with this move here or this move here on the hourly. Remember, for the retracement, this move here is a high quality time associated move, right? This is the last manipulation leg on Friday. Notice how Friday puts in the high of the next week? Because this engages the higher time frame PD array. Look at this. This is an SMT with Nasdaq, if you guys remember. There you go. SMT starts the move. The sell model back down. What do you see here? What kind of move is this? Sell model. Yeah, sell model, right? Remember what I said? You want to frame it as a market maker model in the context of it. What is this move right here? There you go. So now you're looking at time and price and then using logical deviation projection levels. This move right here was algorithmically coded to deliver this exact price target. And we'll talk about that when I get into targeting and price action. I'll get into that in just a minute. Okay, so now let's do lower time frame dynamics, like we said. Don't draw every fucking manipulation leg. It's not going to work. Focus entirely on the narrative associated with the move. The narrative is a high-quality PD array. It frames a dynamic move, a market maker model, and uses time. What do I mean by that? Kill zone, candle open, true day open. All of these things are important to interact with on the lower time frame because they're time-based, i.e. you want to choose a projection inside a kill zone. You want to choose it maybe at a 4-hour candle open, maybe a 4-hour candle open, which is going to be your H4 PO3, which we all know happens every 4 hours. You want to use things like the midnight opening price. As you can see, this candle here comes in and engages this midnight opening price, doesn't it? Look. Do you see that? Comes in and engages this discount of the day. Also engages this 4-hour fair value gap. Nice. So let's take a look and say we're trading the 5-minute chart. I'm not going to be using every single deviation I see. I'm going to be framing it around a market maker model. I see a really nice consolidation here on ES. Do you see that? This is almost a perfect consolidation, right? You have a range, highs and lows. Now I'm seeing this as time distortion in the AM session, the PM session. Look at what time this move happens at. What opens at 2 p.m.? Someone tell me. What hour? 4-hour candle, right? Wait, what did you say? Sorry, I just assumed you said it. My bad. What? PM session, yeah. So this is a 4-hour candle open right here, right? 2 p.m. So what do you think this looks like? What is this? We just said it. Yes. So when you choose a deviation projection, would it make any fucking sense to be like, oh, well, let's just use this one here? There you go. Oh, look, it hit 4th, right? There you go. Does this move have any correlation with what you're seeing with this 4-hour dynamics? Remember, time before price. So here we go, 10 a.m. to 2 p.m. What makes sense in terms of time to frame in this leg? Well, it's obviously going to be this candle, which comes into the 4-hour unicorn, right? And which high you're going to use? Are you going to use this high here? Are you going to go, okay, from this low to this high? There you go. Look at the high of the day. See? But what if you didn't know that? What if you're like, oh, why don't we use this high? Okay, that's fine. You get a similar signal, right? You get the bodies closing at 2.5, right? That's fine. But what's the highest quality high in this leg? In this manipulation protraction leg? Is this high a higher quality high than this high? No, you want to use this low and that high, right? That is framing the protraction. Why this high? It sweeps this liquidity, right? It engages the PDA and then it breaks down. This is the long-term high, intermediate term high, short-term equal highs, right? And this is an even shorter term high in here, right? This is the leg. And if you flip up a time frame, it's obvious. You're going to see in the 50-minute chart, that's the leg, right? Okay, that's the manipulation leg you want to use. And you'll see how beautifully that maps to the 4-hour power of 3 move. Look at the coded terminus for this move, right? That's the end of the day. This happens probably right at 4 p.m., 3:50. See? This is AMD. Yeah, as always, right? This is AMD. This is coded by the algorithm. Look at the 4th deviation here. You say, oh yeah, it maps this liquidity pool. Yes, but so does this one here, the 1.5. You want to be framing just the deviations inside the leg that it makes sense to use. Don't use this for the next day. Don't keep your deviations on forever besides the weekly one. The weekly one is telling you the narrative of this entire move. Then every single day, you're going to choose the highest quality PDA and you're going to use that. Let's make this a different color so it's not the same as the 4-hour one. Yeah, absolutely. Absolutely. Time first, right? So a PDA formed in a kill zone at a open, session open, true day open, or Muse driver, right? Because these are going to be the most volatile and also most algorithmically controlled PDAs, right? If you have a fair value gap formed on a news candle, that's probably a very high quality fair value gap, right? So you want to look for narrative. Like, that's why I say narrative is like this blanket word. And these are all the things we're always considering as ICT traders, right? Time first, always. And then you also want to look at the associated move, like the associated price action with that PDA. Meaning, when that PDA is formed, let's take a look at the 4-hour chart. Do you see how Do you see how this 4-hour PD array gives a large reaction? Right? What about the PD array coming off of that PD array? For example, if we had, here's a good example. Do you see how we tap into, let's do this day. See how we tap into this hourly fair value gap, right? And then we get a large reaction. What do you think is going to happen with this SysD level right here? It's going to be very sensitive, right? Because this is an order block that's an A plus order block, right? Sweeps liquidity, lower time frame, tags a higher time frame inefficiency, and then leads to a break of structure with displacement. So let's go down to a lower time frame here, right? Do you see how we're accumulating inside of that, essentially that breaker? We close above, and then we start to accumulate inside of here. This move down, this manipulation down would be a great, it'd be a fantastic, right, projection leg. Because yes, so let's look at it this day. Let's see how you do projections in the lower time frame. Right? We're talking about that. Let's actually show it on a chart. You would want to use, so for example, what do you think you'd use on this day actually for your manipulation leg, right? This move here comes down, and this is essentially the manipulation leg for the day, right? That's a very good manipulation leg because 2.5 maps to our liquidity, right? And 1 also maps directly to our double top, right? Which is our weekly liquidity as well, right? So this is a very good manipulation leg. Okay, why don't we also take a look at a really high, why don't we also take a look at a really high confluence breaker, for example, on the hourly, which you see, this breaker, or SysD, whatever you want to call it, and frame the manipulation that obviously happens at the breaker. Do you see this move down? This is also at the 11 a.m. candle open. Remember what I said about time? True day open, news drivers, kill zone, candle open, right? Something like that. So this is the 11 a.m. candle open on the hourly, right? Puts up this high, manipulating a high, distributing to a low, rebalancing. Look at this. Look at the bodies. Do you see the narrative of this candle? Right? This is a great projection. This low to this high is a fantastic measured move because that's obviously manipulation, right? You can't say that every down close candle is manipulation. Would you call this, like I've seen people do this, like look, here you go, right? Here you go. Are all of these obvious manipulations lower, or are they just rebalancing inefficiencies? Yeah, but what about this move here? This move obviously is manipulating. The candle opens at 11, puts in a high, right? Again, inducing what? This high, right? Trades away from the liquidity into the highest quality PD array on the chart. This here is not just a breaker. It's a breaker. We'll go up a time frame. It's a, it's on NQ, it's a fair value gap. On ES, it's a volume imbalance. Okay, this is essentially a unicorn setup, right? It's a volume imbalance right in here. Okay, so there's manipulation and there's context associated with that move, right? So this move here isn't just rebalancing, it's manipulating into the higher time or into a higher time frame PD, in this case 50-minute, or this breaker right here, and then distributing higher. Let's see where these levels map to. Do you see that? Look at the high of the day. Look at the bodies. Right? Mostly contained by that third deviation projection, right? But look at do you see how closely 2 maps to our liquidity? And it's also contained in this move here, this manipulation leg. Do you see that? You have the overlapping of these areas right here. So this really high quality protraction or manipulation lower overlaps the obvious morning manipulation, right? This is a really good liquidity target. Remember? And that's why I said this like at noon. Also, by the way, remember the 4-hour targets we had? Remember the weekly one we had? Let's get rid of all these lower time frame ones. Do you see how there's a third weekly second standard deviation here? So there's 3 standard deviations from high quality manipulation legs, right? Where do you think price is going? Let's see. Where do we have that? Right? Standard devs take us to here. That's like a 20-point move that you could anticipate based on just those 3 standard deviations, right? So that's the power of the lower time frame dynamics, is using narrative. And if you want to really simplify that, pick a high quality PD array. Pick a PD array that is framing the manipulation leg for the day on the lower time frame. That answer your question kind of, Niku? Okay. So obviously, yeah, right? It's going to be the PD array that reacts, first of all. You want to see a strong reaction off of it. And it needs to be the one that's based in a higher time frame order flow, like the hourly chart, for example. This is the hourly PD array. Also, what did I say about framing a market maker model? Do you see how this frames a market maker model? So this is really good. Now, this also frames a market maker model. Do you see this very internal market maker model, lower time frame, like a 30-second chart? Watch. Do you see that move? It's almost a perfect market maker model, right? So you want to be framing it off the internal dynamics of price delivery, which is market maker models. Again, this is just part of this LRLR failure swing right there, which eventually gets creamed through. Okay, so that is essentially how we pick our devs and which devs to use. We want to be looking, first of all, for the higher time frame ones always. These higher time frame ones are really the truth. And you guys will see me use these higher time frame ones on the daily chart and stuff like that to get like long-term biases. Let's see. Right, look, this is my Bitcoin monthly chart. Do you see that? Go into your charts after and look exactly where Bitcoin reversed from. Okay? These are monthly charts I'm looking at. Look at this daily chart. Do you see this is Dixie. Do you see the accuracy of these projection levels because they're based on higher time frame manipulations, right? This right here is a beautiful manipulation on a higher time frame, which frames the entire market maker model down. So that's what you want to look for. Focus on the higher time frame dynamics. One of my students, Snake, literally wrote that out today. Higher time frame draw over lower time frame dynamics. It's a very important consideration at all points in time. The higher time frame chart is the truth, guys. It's the Bible, right? Like the daily, the weekly, the monthly, the 4-hour. These are the charts that really tell you where a price is going to go. Now let's talk about quick link. I'm going to get rid of this. I'm going to take a screenshot, put it in the education. Screenshot, put it there. Okay, get rid of that. Now we're going to talk about which levels to use and what we expect at each level, and then I'll talk about time-based projections just briefly because I'm still kind of fooling around with these. There's a guy on Twitter called The Pragmatic, who I'm kind of not stealing from, but I'm trying to build on the concepts he kind of published on time-based projections. Okay, so what do each of these levels mean? Now, generally speaking, there's only 3 levels I want you to focus on. I want you to focus on 1 to 1.5. That's smaller. 2 to 2.5. Oh my goodness. 2 to 2.5. And 4. Just 4 as a level, not a zone. Okay? So 1 to 1.5 is dubbed the SBZ zone. SBZ accumulation. This is the silver bullet accumulation. Now, it's just fucking words. It doesn't mean anything. What you want to look for in the 1 to 1.5 deviation range is the second phase accumulation of a market maker model. You can clearly see that on this 4-hour chart. This is the SMR down here. What is this here? First distribution, correct? What is this long wick? That's your first accumulation, right? Let's pull up. That's fine. I don't have the. Let me pull up this. It'll be easier to see it. Right? This is called your what? Right in here, right? Actually, it's right in here is your low risk buy, and this is your first accumulation right in here, right? This RDRB is your low risk buy. It's before even you get that market structure shift, isn't it? Preemptive market structure shift, or using this redistributed rebalance PD array. But this would be considered based on this schematic, right? Your low risk buy because we get the market structure shift. Then we have this accumulation as low risk buy, expansion. In here we have a secondary accumulation, right? You can see it. Price isn't expanding in this. And this is, remember, this is almost 8 hours of price. Let's look at this on a lower time frame. Sometimes hard to see when you're looking at the higher time frame only, so let's zoom in. Well, now this looks like a very clear accumulation, doesn't it? Right? So here, let's look at the 1 hour chart. SMR. What's this called? Low risk buy. What's this called? First accumulation. Oh, 1 to 1.5 is what? Second, yes, so second phase reaccumulation. Okay, that's the zone. Boom, high quality PD array. What does ICT say about the first distribution in comparison to the second one? Which one's more explosive? Second. Good. Nick, did you get that? So, yes, that's a very good concept. So ICT Twitter space. I'm gonna just ask if he's for which one. I have it in my Notion notes. Literally, like I think at the 3 hour mark, back like deep in the Twitter space, he says something. He says second phase distribution is his favorite model because it is the most explosive and most likely to not result in another failure swing, i.e. LR generation. Now, that statement is so powerful because look at what happens when you get these failure swings. It's devastating, right? Failure swings can be devastating to your because you usually take huge losses or you have huge drawdown in terms of trailing because you're holding to liquidity because we partial at liquidity. So the second phase distribution is more likely to not put in a failure swing and also be more explosive. And I have to find this Twitter space. I think it was like his second last Twitter space, right before he posted the lecture on market maker models. He said this, and I remember it, and I wrote it down, and I said, okay, so now this SBZ reaccumulation zone is something I'm going to consider because I'm going to be looking for second phase reaccumulation in the standard deviation projection inside the weekly profiling. Remember, we're combining all the concepts. Weekly profiling, projections. This is the weekly SBZ. Powerful, powerful concept. Notice how there's tons of other lower time frame secondary reaccumulations, right? This is a market maker model, this is a market maker model, this is a right? But on the weekly profile, the only second phase distribution is this one right here, right? And then boom, that's an explosive move. No failure swings put in. Except we have this one right here on news. But it's the reaccumulation zone, right? So because this is the reaccumulation zone, we get that SBZ reaccumulation. Fantastic. So that's one zone I want you to pay attention to. 1 to 1.5. I must have some more examples of that. Let me try and go to daily recaps and show you if I have any other marked out as silver bullet. Okay, right in here. Do you guys see this? 1 to 1.5. Price comes in, right? Puts in some LR, right at the CPI candle high, which is where? Which zone is that in? 2 to 2.5, right? Reaccumulates beautifully with this immediate rebalance. You could buy that immediate rebalance wick, but the thing that's not on your side here, right, is time. So in this case, there's a news driver, I believe, here, and then we're waiting for this order block associated with time. Remember I said high quality PD array, right? Is this fair value gap the highest quality PD array on the chart, or is it this order block which is associated with this news candle? Because the news manipulates a high, right? Then puts in this order block before breaking structure with this tiny fair value gap. Is this an A plus order block? Yes, right? Internal liquidation tags a higher time frame array. Do you see this hourly BISI and this 5-minute gap in here? Then breaks structure with market structure with the displacement. You see that tiny 5-minute fair value gap in there? Then breaks structure again. These order blocks, specifically that one, is the highest discount array, the most discounted array that price would want to return to. Boom, 1 to 1.5. Do you see this is the second? Do you see this is the first distribution right here? And this, I don't have the, actually I have the hourly chart right here. You can see it. Okay, do you see how London is the first distribution of this market maker model? Do you see how I have it marked out right there? Okay. Now, I should have drawn out the deviation projection in the lower time frame, see where it mapped to. But right here, you can see in this market maker model, just up to this high, this is our secondary reaccumulation right in here. Tags this SBZ zone, right? This is the one of the accumulations we're targeting, and this is the higher one. We take out the first accumulation. We take out the first accumulation of this 5-minute model, retag this within this zone, and then deliver all the way to 4, which you're going to keep as a terminus for price delivery. So fourth deviation is the terminus for price delivery. Okay, so 1 to 1.5 is SBZ reaccumulation, 2 to 2.5 is your likely reversal, and if we displace through 2.5, then you want to look for 4, which is going to be the terminus. So let's see if we can frame a move around that on this move here. So we have this low to this high, right? So 2 to 2.5 is a really good target, and if we displace with inefficiency through this, we can likely target 4. So now that we've seen we've displaced, we want to look in this zone and see if there's inefficiency. Well, I see some, right? Maybe on the hourly chart. Yeah, I see a nice inefficiency right here, right? Do you see that? So it's likely we're going to displace through that and then go to 4, which also lines up with what on our weekly projection? Right? So these are all coded levels, and then the overlap of these measured moves, even this measured move, for example, is a really good one to use for next week, right? This measured move is fantastic because it has a high narrative associated with it. This is the move that leads to the second phase distribution of the market maker model, right? That manipulation right there on news. Remember? I deleted it. Remember, this is a news-based manipulation, this in here. Fantastic. That's an area you want to look for now as a high quality set of standard deviation projections into next week. So maybe we'll see this. What zone is this right here that we're currently in? What do you think price is likely to do in here? Yes. So now you're going to remember this stage. Each subsequent projection, right? Forecast, or each previous projection forecasts the next price action move in the higher context of this weekly profile. So if you ask me what's going to happen next week, based on just this weekly profile we saw last week, again, we're going to have another one this week, and we have this manipulation leg. Monday is typically a what day? Consolidation, expansion, or reversal day? Where are we what are we in right now on this hourly standard deviation projection? Look at how time and price are aligned. You see that? So Monday, we can accumulate. Tuesday, manipulate, right? Into this PDA. Break structure. Wednesday, expand. 2.5. If we expand through that, we can keep going higher because NASDAQ's draw is what? Look at NASDAQ right now. Do you see how we closed above this 2.5? Okay, now look at the hourly for NASDAQ and let's use that same measured move. Oh, that's funny. This 17,595, right, is the terminus of this daily swing high, okay? And the terminus for the weekly manipulation, right, is this all-time high. Now let's take a look at the hourly chart again and see if we can map time with price. So now we have this reaccumulation zone, and we actually have left a nice inefficiency in. We've hit 2.5. Right. Look at the high of the day. Do you see that? So close to that manipulated level, right? The projected level. Now what we can do is based on just time, I'm not even considering price, just time, what can we do? Well, Monday can accumulate. Whoa. Monday is free to accumulate. Tuesday can manipulate. Wednesday, Thursday, Friday. Look at this fourth deviation, mapping perfectly to our liquidity pool, right? This is kind of the internal daily power of 3 move that these projections offer you, because look at where we are in the context of the entire move. So I'm getting a call from the vet. 1 second. Yes, it is. Hi. Hi, Charlene. Yes. It was earlier. It's not anymore. I've like bandaged it up with like a shirt of all things, just to keep him from licking the wound and stuff like that. I didn't necessarily look, but I would assume so, right? Oh, yes. I didn't see it at all. I was actually out of the house. He was taking a nap. When I came back, I saw the blood on the the blanket. So I wrapped him all up in a couple shirts now, so he has no access to the wound. He went home with a cone. Yeah. No, he had a shirt on. Like the same thing. Like the cone he gets because he's quite agitated. The cone he can never really settle in. So I've been wrapping it up with the lick sleeve and a couple of shirts, which usually works. That's what I did last time he got his hip done, and it worked very well. No, no. He got home about like 6 days ago. He's been home for over like, about a week. Yeah, 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 yeah. He might have like accidentally nipped himself. There, yeah, yeah. I think that he might have been able to pull the shirt off. That's why, like that part of it, and then he might have like at this time I double shirted him and double wrapped it. um, mhm. Okay, okay. Yeah, yeah. Okay. Yeah. Okay. 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 Yeah. Okay, that makes complete sense. Yeah. Okay, and as of now, you don't think there's any issues. Okay, I really appreciate that. Thank you so much. Okay, thanks. Okay, sorry about. He's been going, man. He's had a rough couple months. It's tough being him right now. um, can you guys hear me? Okay, cool. So again, just based on time alone, this looks very likely to me because we have not displaced through this 2.2 to 2.5 region, right? This is a likely reversal area. And in fact, I don't know if I have my charts. Did you guys ever see? I sent a picture in general last week of my NASDAQ chart with a blue box, which was my reversal area. I really wish I added these things to somewhere where I could refer back to them, but I might not be able to find it for us. Okay, I'm not gonna. Okay, I'm not gonna look for it too much. Sometimes I'll do this, guys, on my charts. I'll draw these boxes of price, and I'll just keep this on my chart as an area to reference, so I can remember this higher time frame STDV, right? So for me, I'll be able to remember that like Okay, this in here is a likely reversal reaccumulation area. And if we manage to reverse and then displace through 2.5, I'll now be looking for 4. That's just kind of how I'll keep a mental track on things. Now, what I also want to teach you, right, is the difference between how you can use standard deviations in conjunction with market cycles. So obviously this is expansion that we're framing here, right? What about a consolidation or a reversal or a retracement? So like I said, we're going to look for retracements and reconsolidation, so reaccumulation inside 1 to 1.5 and 2 to 2.5. So you're going to think about the area between 0 and 1.5 is going to be expansion, and then the areas between 1 to 1.5 and 2 to 2.5 are going to be potential recycle, reversal kind of areas or reaccumulation. If we can displace these areas, we're going to consider the area from 2.5 to 4 as expansion. So if I can just write out some little word, like E is going to be this area. Now this can be here at 1 to 1.5, retracement or reversal, but it's more likely to be retracement. So let's just say retrace. Now in this case, 2 to 2.5 can be retrace or reversal, a full-on reversal. And if we expand through this, we're going to call 4 terminus. So that means that from 2.5 to 4, we can consider that to be expansion. This is the internal logic of these standard deviation projections. Expansion, retracement, reconsolidation, retracement or reversal, expansion, terminus. Do you notice how this aligns pretty much identically with IPDA market cycles? Expansion, retracement, expansion, reversal or retracement, reconsolidation, expansion, reversal, right? Do you see how all of these phases are exactly what the market cycles are? That's the internal consistency of standard deviations. They frame the market moves. So why don't we build on that? One concept we can add to that, which is novel, which is not going to be taught by most people, is if we can expect, right, that these moves have coded levels for retracements, expansions, reversals, what do you think is a good let's just look right at the fourth deviation. Let's ignore everything else. What do you think the fourth deviation in terms of an entry pattern is optimal for? There's one entry pattern. That's entirely reliant on catching the top or bottom of a market. It's 2 words. It involves a turtle. The fourth deviation, fees will only take turtle soup setups off the fourth deviation. That's my gem for the lesson, 3 hours in. I will only risk a high risk turtle soup entry if there is a narrative of a fourth deviation. And watch the times where I've taken turtle soups. It's always based on terminus in terms of liquidity and terminus in terms of a mapped deviation. Do you see how this perfectly maps with our daily high? This fourth deviation here? I would turtle soup this area, guys. Or I would be more likely to take a turtle soup, meaning this is the hourly chart. Remember how I usually say wait for hourly break a structure? Sometimes you'll see that I'm somewhat contradictory and I enter early on lower time frame dynamics, right? Because I'm using this context. Fourth deviation, this is a weekly ERL, or is it a daily ERL in this case, right? Oops, let me put this at the end so we can see it. Right? There's context, so I can look for a lower time frame move expecting this. Where's the ultimate draw on liquidity? All-time highs. This move is coded to end at daily ERL. We're not going to do this. I promise you, if we come into here, we will retrace. And a retracement on a higher time frame looks like what on a lower time frame? A reversal, yes. Oh, look at the market booking these cycles. Do you see that? So this is what I will look for if we come to the fourth. And I'll be likely to play a lower time frame model in here because I have the narrative of this level with this coded algorithmic move. That's why you can be more precise and not just be like, yeah, I'm a turtle soup trader. I might take every turtle soup. Look at this. this move in here, right? Down here, if you wanted to take this SMT with NASDAQ, this is the last manipulation leg lower. Okay. Oh, look at this. Do you see how this fourth level of liquidity? Look, what happens between, okay, this is the hourly chart, but we can assume based on the candles. What happens between 1 and 1.5? Huge reaccumulation. Yeah, huge, right? Into what? This order block, correct? Or this immediate rebalanced wick. Funny how it comes right into 1.5. Do you see that? Okay, nice. Then 2 to 2.5 is expansion. We expand through 2.5, so we expect somewhere near 4. It doesn't have to be exactly 4. What is near 4? That's obvious. Now, don't be one of the guys who are like, Afeez, it didn't go to 4. Yeah, of course not. What's right? What is the obvious place it's going to? Right there. I don't need it to go to 4. This is 4, right? Look for liquidity targets. Sure, it could have come into this fair value gap. That would have been nicer, right? But there's obviously a massive swing low here and a massive inefficiency. This is a 4-hour gap as well that we're in, on an hourly gap too, right? It fulfilled this gap to the tick. Do you see that? That's narrative. Okay, so once we do that, I'm likely to look for a turtle soup here. I'm not bullish yet, right? The market structure shift isn't until we break through this low. But I'm willing, the market structure back to the upside never even happens. But I am totally willing to take this 2 p.m. move higher even, right? Or this 10 a.m., 11 a.m. move higher based on just this narrative. And that's why you can, but this last manipulation, like right here. This was CPI, right? So I'm willing to take that trade there. What about, let's look at the daily chart, 4-hour chart, see where we get that move lower. Okay. Yes. Yes. Okay. So for me, this move down based on this so why do I choose this leg and not this leg, right? Remember what I said about the 4-hour? What are you seeing on this 4-hour candle? What is it doing? Taking major liquidity, right? Yeah, and SMT. And it's associated with LRLR, which is also narrative, right? LRLR generation. Are we bullish or bearish? So when we see LRLR, that move that creates LRLR, what the fuck do you think rests above this high now? Yeah, a shit ton of money rests above this high, right? So that is a narrative-based move I'm willing to draw a projection off of because it makes sense. There's logic to that. There's internal consistency. Now, when we hit this first deviation and we form the SMT, I'm likely to take a turtle soup here. So it could be the fourth deviation for these longs, but you see how for this it'd be the first deviation? Because I'm not bearish. I'm not expecting delivery down to here. I'm expecting this first deviation between 1 and 1.5 to be a reversal. And then now we can expand higher. So there's certain areas on the chart where I will look to take turtle soups. Let me see if I can find some lower time frame ones for you guys to make it even more clear. So this move right in here, I'll use 5 minute because that's the chart we usually are used to seeing. So I'm bullish, right? Bullish on this day in New York at least. And I see this meaningful late London protraction. Okay. Again, look at the low, right? Very close to that third deviation. I would take, maybe not a turtle soup because it could come down to this daily fair value gap, and I didn't know it would form an SMT, right? But say we came into this fair value gap, right? The daily BISI. You bet your ass I would turtle soup that. Why? Look at the narrative. Fourth deviation inside the fair value gap, which I wanted to go long from. Do you think I'm more or less likely to have to wait for hourly confirmation, Yusuf, if I see that? And it has narrative, right? Fourth deviation and this massive period I've been waiting for, right? So that's where a turtle soup candidate could be nice. Maybe if you're trading in London and you see this measured. No. I would a turtle soup means I would wait for like the hourly wick. So I would probably get in on just a 5 minute market structure shift without an hourly market structure shift. Make sense? So like, for example, here, I would get in on this fair value gap right here. So I'd wait for a 5-minute MSS, like right there, and then I would use this fair value gap. Make sense? Because I'm anticipating a power of 3 move, right? Based on that turtle soup entry. Likewise, let's look here. Say I'm trading London. I see this meaningful protraction into this fair value gap right here. This happens right in Asian session. Push up. Where would I want to use my deviation projections from on the hourly? We don't manipulate. Actually, we come back into this breaker. Yeah, so maybe we could use this. Yeah. I'm using the manipulation leg in this case. Do you see this manipulation leg on the hourly? It's just one candle. On the 15, you'll see it's multiple, right? Why am I using this and not this one right below it? Why aren't I using this manipulation right here? Look at the time of this. It's Asia, right? I care more about the London manipulation because there's a narrative and trading back into what? The Asian breaker, right? I care about that manipulation more. It's a kill zone based projection. Turtle soup the fourth, maybe. Aim for internal rebalance, right? Something like that. Let's see what it looks like on a 5-minute chart or 1-minute chart, because that's 15-minute projections. So let's go 1-minute chart, all right? Just to make sure we're time frame consistent. So when you see fourth in the kill zone, you could turtle soup this high. There you go. Because now you're trading the London reaccumulation lower into like whatever the fuck this chop is. And again, you can go to Dexter's fucking Twitter. He does a lot of examples of this. I'm just saying there's only certain areas where I'll look for aggressive entries, and those line up with my standard deviation projections. And if they don't, like let's take a look at this reversal down here. Again, do you see how this is a reaccumulation zone? 1.5 to 1. Do you see that? Now look where it's reaccumulating. The most discount PD array on the chart is this breaker or order block, right? 1 to 1.5 reaccumulates. What's happening in here? What's all this? Yeah, it's it's also time distortion, right? Because New York comes all the way in, and then Asia pushes up. This in here is all time distortion. London, you get your entry. That's why you wait for a kill zone. Now, boom. Now, what would I measure? I have this projection here as my high quality, right, projection for the day. Oh, that's random, right? That's a very random spot for us to stop moving higher. But if you didn't have this one, you didn't see that, which is fine. You don't have to see every single projection and what it means, right? When we come into this breaker, I'm going to make this wider. When we come into this breaker, you can also frame this manipulation. Why is it a high quality manipulation? Because this is the area that was responsible for this protraction lower, right? Now this leg here should frame the daily move. Oh, look at that. Right? Again, now you know before New York opens what the daily move should look like based on just this narrative. So I use two different projections. This one here is projecting the entire move, right? But this London retracement right here, is this like an A+? Is this a high quality projection? Yes or no? Does it fit all our criteria for high quality projection? It's in a kill zone. It tags a higher time frame PD array, right? And it's associated with the power of 3 move. Accumulation, manipulation, distribution. Fantastic. So let's get rid of this one and just use this. 1 to 1.5, we don't get reaccumulation. We hit 2 to 2.5. This region is another area for reaccumulation. And if we displace through, where are we going? You see we reaccumulate slightly into a 2.5 here for like an hour. Okay, that's a reaccumulation. We're going to 4. So you can use this, and now you can go maybe down to the 1-minute chart because you want to use time frame alignment. Remember, hourly projections, 5-minute model, 5-minute model, or 4-hour projections, 15-minute or hourly. Fuck, it's 2. I'm just going to go 5 because I don't want to use the 1. In this area, I can now see in New York, say I don't get in pre-news, right, or on this 9:30 pump. Okay, that sucks. But now I'm in this zone, and I can see us start to accumulate. Now I just wait for a high confluence entry. Okay, so we hit 2.5 right here. Again, not you're going to start seeing it's not very random, right? We hit 2.5. Now what happens? We reaccumulate. And I know we're likely to go higher because this isn't. Does this look like a reversal to you? No. Look how we're respecting bullish PDA arrays. Look at the down close candles. Look at the down close candles supporting price. Yeah, we could. But what's the draw on what? We could come all the way down to here. You're right. Yeah, but do you see this immediate rebalance wick right here? And then do you see these down close candles supporting price? Do you see like just this down close candle right here? Do you see that? 1, 2, 3. Do you see we're not moving lower than this down close candle body? That's narrative, right? You'll often hear me say like, you have to look at these down close candles because this is essentially a snorter block, right? No, but you're not, and you have to take a risk, right? Because you're already in a premium, and you're probably not going to get a better discount entry unless you get in somewhere here, right? But you can use the benefit of these standard deviations, right? Well, this is likely a what zone? Reaccumulation or reversal zone, right? So if you see bullish order flow in this zone, what do you think's going to happen? Yeah. But if you want to be safer, what can you wait for? Displacing 2.5, remember? So we displace this. Now look for the next. Look at this PD array right in here. Perfect, right? So you take a risk. So you go here and you have to risk this low, and you have to target the fourth. Now the fourth isn't a random spot either. You're going to see. Look. See that? Remember, if your targets don't map to liquidity, they're fucking useless targets. Liquidity is the life force of the market. So when I see this fourth, I'm not just like, yep, holding till fourth. No. Do you think I would have held till fourth there? No. I would have taken everything off. Where the fuck did it go? I would have taken everything off right here. But as you can see, price makes one last jab higher at 350, right into the fourth, right? But I'm taking it all off here because this is obviously the same as this shit. This is mapping to your liquidity, right? But you can use the context of these areas to say, are we reversing? So this is IPDA market cycles, right? Remember we talked about that. Are we reversing? Are we retracing? What are we doing? And you use these deviation projections to frame the next move. Remember, every previous deviation frames the subsequent move in the market. That's how the market works. It's booked on time and price, and these projection levels are just telling you about time and price. So 1 to 1.5 in here, you can see we reaccumulate. Do you see how this opening play on the hourly is inside this 4-hour 1 to 1.5? Reaccumulation, distribution. Now we're in 2 to 2.5. We'll see. Maybe we'll reaccumulate in here, right? We'll do this. We'll have to see. But we use these as helpful aids in understanding, like, which liquidity pools to target. Obviously, the fourth year is a really nice liquidity pool. So is this on a higher time frame. And then we just look for obvious areas of reaccumulation, reversal, distribution, expansion, whatever. The last thing we can talk about quickly is time-based fibs, which is essentially going to be we want to measure moves, right? So you see how this move is the obvious weekly manipulation we said? This move right here on the 4-hour. All right, let's take a look at this and see how this happened in time. So the same concept that we want to use for price, we can use in time, and we can see if we can find any sort of entry, right, in this manipulation leg lower. This manipulation leg lower took, roughly 1, 2, 3, 4, 5, 4 hours, right? So then the 4 hours on the other side should frame the reversal out of there. And as you can see, if we make this smaller and hop down a time frame, right, we get a nice entry in that 2 to 2.5. Do you see that? Right in this order block. Right? So that's something else you can do. And that's for framing these lower time frame dynamics in terms of symmetrical price moves. Because a symmetrical move up should be a roughly symmetrical move back up, or down should be rough. But that's something I'm still kind of experimenting with. Last thing we'll talk about real quick is the CBDR. The CBDR is defined by the period of time between 4 p.m. and 8 p.m. and it looks something like this. You take the lowest low from 4 and the highest high until 8, and you project that. Now, CBDR is fantastic in lieu of projections, and some people use it religiously. I used to use it a lot more. As you can see, the sensitivity of these levels, right? This is the fourth deviation. This is the first deviation. Yes, 4 p.m. low to 8 p.m. high, whatever the lowest and highest candles are. So, for example, here, if we take a look at 4 p.m., the highest candle is going to be right here, and the lowest candle towards 8 p.m. is going to be right there. Look at how London accumulates at that fourth deviation. Do you see that? So these are important pivots in the market. Some people use them because it's the central bank dealing range. That's where the dealing range for the day is kind of set up by the central bank, is what they say, because this is when the markets gap up or gap down, because this is the spread hour, and this is where orders by central banks are filled. But I don't really know if I use it that much these days. But again, the logic is there. So you want to use from 4 p.m. you want to use the highest high to 8 p.m., which is going to be the lowest low. And again, right, there's very sensitive levels here. And you'll often find that inside bar days like this are contained very well by these levels. We can do one more example. Let's do a day that expands. I want to see. So this is 8, that's the highest high, and then 4 is there. And there you go, right? Do you see how we interact with this 1 to 2, and then we rocket higher? So again, they're nothing like religious or like, there's no creed around this like that. Oh, it's the exact levels, but it is very interesting. I do sometimes look at it. Here would be another example. We have this low, this high, and you can see what you could. Oh, we're talking about the CBDR, central bank dealing range, from 4 to 8 p.m. Yeah, no worries. So essentially what we're saying is that the time between 4 and 8 p.m. is also another projected time which you can use to measure a daily move, which is called the central bank dealing range. It's the 4 p.m. low. Whatever low that exists between 4 p.m. and 8 p.m., whatever low and high that exists between 4 p.m. and 8 p.m., you draw those out. So for example, it'll be like that. And then you look at the sensitivity of those areas throughout the day. As you can see, they're key pivots, right? Do you see that? Asian low, Asian high, and this first deviation. So it's pretty interesting stuff. And some days you'll get really nice reactions from them. So it's another tool you can use. It's another standard deviation you can use. I'm not a huge fan. I'd much rather use standard deviation projections. But like, look at this. You see this sensitivity to, and what I said is that inside bar days are generally very well contained by this. So when you see inside bar days, look at the. This is essentially projecting the Asian range, and ICT has a lecture on this. So this would be core content. I forget which month, but it'd be projecting the Asian range. Essentially what you're doing here is you're using the Asian range as a barometer of where price will interact with levels. And it has very interesting results sometimes. I'm not a huge fan of it, but I have used it in the past. So here's another example, right? Yeah, like you'll see that there are strong pivots, and inside bar days tend to be contained by them. I want to see a day that has like a radic expand. Like this would be interesting. 4, where's 8? There you go, right? So you get some interesting price action at these levels. Right, you'll see price refer to PD. I like that. PD arrays at these levels are often referred to, right? It's like that order. Yeah, sure. I can just screen. This is the CBDR fib template. and you want to anchor high at the highest wick between 4 and 8 p.m., anchor low at the lowest wick between 4 and 8 p.m. Yep. Okay, so that's the last kind of projection thing that matters. Really, out of this, you should have got the standard deviations are a very powerful tool, but they're very, very mischaracterized and honestly misutilized. Like, people use them wrong all the time. Focus on your 4-hour deviations. The rest of it's kind of bullshit. there is better time frame lower ones. Yeah, dude. Think about higher time frame dynamics at play. This weekly manipulation is what you care about, right? This SysD right here is what you care about. Look at how sensitive price is to this breaker, right? And this immediate rebalance on the 4-hour. Do you see that? This also forms another lower time frame SMT. Look. Where's the S? Do you see that? It comes back into this, whereas NASDAQ doesn't. So this move in here is projecting a price move, right? Go to the lower time frame. Right? Oh, look at that. Look when this happens. New York kill zone interacts with the 4-hour breaker. This would be a really good deviation projection, wouldn't it be? And look at where it maps to, right? We just had this one on our chart like a couple minutes ago, right? So this is where it maps to, the same liquidity pools as this one. So yeah, you want to look for narrative associated with your projections. And I would just say, don't never have more than 2 on your charts. Like, I've seen people who have like projections literally out the yin yang, man. They're everywhere, but they're useless, right? They need to have a lot of narrative associated with them. Stick to the 4-hour ones. Like, you'll see that the ones I care about most are always like daily charts. Like, I will care, like, look at this monthly chart. Do you see this monthly chart right here? Look at that. 2. 1 to 1.5. Do you see we get a reaccumulation in that area? And we've actually hit this. We've actually hit these levels. We hit this level because the contract rolled. All right, so I will use these higher time frame deviations regularly. Trying to see if I have any other long time frame charts. We did not. We are close. Let me check. I'm gonna delete all this. I'm gonna also stop the recording as well.